Let's continue to look at the financial institution. We have seen a financial markets in our previous videos, which is one of the components of financial system. So now let's proceed looking at a financial institution, which is the other component of the financial system. So these financial institutions can be classified as depository and non-depository. They are institutions which provide a financial service for the customers. We have deeply looked at mutual funds, investment companies, insurances, and pension funds in our previous chapter. These are a non-depository financial institution. So let's look at about commercial banks, saving loan associations, and credit unions, which are depository financial institutions in this chapter. So the primary function of commercial banks is accepting deposits. Their primary function is accepting deposits. Mostly customer deposits are short-term liabilities for them because we do not know when people ask. So that means their liability is mostly deposits and individuals deposit, and their asset is the money they borrowed. Like think of it as an account receivable on their balance sheets. On their income statement, most of their revenue is a spread. What is a spread? The spread is the difference between the bank lending rate and the bank borrowing rate. So the interest they pay for the deposits and the interest they receive from the money they borrow for other person, the difference between that is their revenue, which is called a spread. For example, if the bank lending rate is 7% and the bank asks 14% for the one who borrows from this bank, the difference between this 7% and 14% is 7%, which is a spread, can be considered as a revenue or income. The other is rental income. Next to this spread, their main revenue is the rental income. If they have a big building and do not use all of it, they will rent some of the portion, some of its part, and that might be also used as an income for the institution. The other one is service fee. A bank charges some amount of service fee that might also be considered as their revenue in their income statement. They are established aimed to get a profit. As we have discussed before, demand deposit, saving account, and fixed deposit fixed accounts are the main risk associated in banking industry. Is the first one, the credit risk. A credit risk is when other people borrow from the bank but fail to return, which is known as a non-performing loan. Risks in banking, risks in general, can be classified as systematic and unsystematic. The systematic risk is a risk that cannot be avoided by the company. However, unsystematic risk is a risk that can be avoided on the performance of the company. So if the company wants or works hard, it can avoid unsystematic risks while systematic risks remain. So credit risk is unsystematic risk, means that the company can avoid this kind of risk. This risk can be minimized by proper credit assessment, loan diversification, a risk management practice, and regulatory frameworks. A company should know for whom he provides the credit, so he should evaluate the credit worthiness of the borrower. This is one method of reducing non-performing loans. The other risk is a market risk, which is, so this happens to every company, not individual. A market risk is a variability of return arising from a boom, or boom means getting up, and bear is drop of the market price that occur due to tangible force. A tangible force might be visible events like earthquake, a recession, or intangible force that are a market psychology, for example, that can be created by this tangible force. For example, if let's change our attention to airplane industry. For example, if some natural accident happens to the plane, which is a tangible force, the market psychology might be changed, and for example, the accident on the Boeing airplane. This accident made the companies to drop. This kind of risk is unavoidable.